Up 315% this year alone, ImmunityBio, trading under the ticker IBRX, is disrupting the massive healthcare space. The oncology market spends $200 billion annually, yet it relies heavily on high-dose, toxic chemotherapy. This approach floods the body with poison and frequently results in high patient relapse rates. ImmunityBio attacks the disease differently. They use a method they call the triangle offense to treat cancer. This conceptual schematic shows the triangle offense logic in action. Rather than solely poisoning the tumor, it reprograms the host's own immune system to achieve long-term remission. It activates 3 distinct biological vectors at once: natural killer, or NK cells, which destroy infected tissue, alongside T cells and macrophages, which identify and consume cellular debris. Because this cellular science is actively working in patients today, IBRX represents a unique market anomaly, a heavily discounted stock sitting squarely on top of a short-squeeze powder keg. The engine behind this growth is their flagship commercial immunotherapy, Anktiva. Anktiva is an IL-15 superagonist, a synthetic protein stimulating immune memory, currently saving patients with highly resistant forms of bladder cancer. This bar chart compares previous year sales to the 2025 revenue numbers. You can see a massive 700% vertical growth, with 2025 sales reaching $113 million. That revenue proves the scientific viability of the drug in the open market. A major macro catalyst driving this growth is a global shortage of traditional BCG treatments. BCG is a widely used tuberculosis vaccine that also treats early-stage bladder cancer. With supplies drastically low, oncologists are relying heavily on Anktiva, which has proven superior combination efficacy. The drug's success extends globally. ImmunityBio has expanded Anktiva into 33 different countries, securing distribution partnerships in the Middle East, particularly in Saudi Arabia. The next major regulatory hurdle is a supplemental biologics license application, or SBLA, which the company resubmitted this March. An SBLA formally asks the FDA to approve an existing drug for new treatments. Approval here would trigger a massive upward valuation re-rating. Looking toward the future clinical pipeline, ImmunityBio recently achieved a crucial manufacturing milestone. They successfully scaled the production of cryopreserved NK cells, freezing and shipping off-the-shelf therapies for upcoming lung and brain cancer trials. Anktiva's revenue streams provide the capital necessary to fund the rest of the pipeline, shifting the company's valuation away from pure clinical speculation. This dual-bar visualization contrasts the stock's current price of $8.23 against its intrinsic value of $36.55. That 77% undervaluation gap comes directly from discounted cash flow models, an analysis method valuing investments on expected future cash flows, projecting the company turns cash flow positive by 2027. Bearish investors frequently point to the company's $342 million cash burn. However, management recently executed a $460 million at-the-market offering. This ATM allows a company to sell newly issued shares gradually into the open market. This specific cash injection resolves the debt deficit without triggering the sudden dilution panic that typically scares away retail investors. On the trading floor, Wall Street's positioning tells a different story. There is a massive short interest betting against the stock, specifically 132 million shares. That ties up exactly 42% of the available float, the total number of shares actually available for public trading. This simplified options chain visualization shows exactly where retail traders have set a trap for those short sellers. You can see massive volume spikes heavily concentrated at the $8.50 and $10 strike prices. These are call options, giving buyers the right to purchase the stock at those specific thresholds. If the stock price breaks through that $10 call wall, it triggers a gamma squeeze. When those options contracts suddenly become profitable, the market makers who sold them are forced to aggressively buy actual shares in the open market to hedge their risk. This creates a feedback loop of buying pressure, forcing short sellers to cover their positions at increasingly higher prices to limit their losses. Wall Street's mathematical positioning completely ignores the company's underlying biological reality. That critical blind spot creates a highly combustible technical setup. ImmunityBio operates on 2 distinct engines. The commercial revenue de-risks the downside, while trapped short sellers provide the fuel for explosive upside. The biotech sector remains highly volatile. Sudden clinical trial failures or broad market sell-offs can easily erode value. Yet, those risks sit alongside current analyst price targets pushing past $20 a share. ImmunityBio proves that strong clinical science can force the market to reevaluate an entire sector. It is a tangible change in how we fight cancer at the cellular level, and a direct challenge to how Wall Street values medical innovation.